Imagine you're on a commercial jumbo jet, right?
Okay.
And you're cruising at this record altitude. But you look out the window and, well, you realize only 2 of the engines are actually firing.
Oh, wow.
Yeah, the rest of the plane is basically just dead weight, just getting dragged through the sky.
That is a terrifying image.
It is. Welcome to Tech Money Madness, your daily U.S. stock market deep dive for May 28, 2026.
Glad to be here.
So today, we have a very specific mission for you. We're going to unpack the exact drivers behind the S&P 500 and the Nasdaq hitting brand new record-closing highs today.
Right.
And doing it despite a remarkably turbulent economic backdrop.
Yeah, the charts today are definitely making history. And I think understanding the mechanics behind this move is it's critical for you to grasp. We are essentially looking at a market suspended by 2 distinct pillars right now.
Okay, what's the first one?
On one side, we have this sudden easing of geopolitical tension. This is driven by the U.S. and Iran officially agreeing to extend their ceasefire.
Right, huge news.
Exactly. And then on the other side, we have an absolutely unbridled, hyper-concentrated frenzy in a very narrow subset of tech stocks.
Specifically the ones linked to artificial intelligence.
Right. So we are seeing a handful of heavy hitters, primarily Nvidia, Apple, and Alphabet.
Just doing all the heavy lifting.
Exactly. They are pulling these major market cap weighted indexes upward all by themselves.
Which goes back to the jumbo jet analogy, right? That narrow market breadth is the key here. The S&P 500 might look like it's soaring, but the number of stocks actually participating in this rally is it's surprisingly small.
Very small.
So before we put those specific tech engines under the microscope, we need to understand the macroeconomic weather this plane is flying through.
We do.
Because the reality on the ground is starkly different from the reality on the trading floor. Let's start with the April inflation numbers.
Right. So the data paints a pretty complex picture today. Overall personal consumption expenditures, the PCE, that rose 3.8%. However, the core PCE rate came in at 3.3%, which, was generally in line with Wall Street's expectations.
Right. And for anyone listening who might glaze over at financial acronyms, let's just quickly clarify why the market fixates on that specific core number.
Good idea.
The Federal Reserve prefers the core PCE because it strips out the highly volatile prices of things like food and energy.
Yeah, it gives them a much cleaner look at structural inflation.
But here's the friction point, right? Like 3.3% is still stubbornly above the Fed's 2% target.
Very stubborn.
And while that might just sound like some abstract economic metric, we got a corresponding data point today that shows the real-world consequence.
Oh yeah, the savings data.
Exactly. The U.S. consumer's savings rate has plummeted to its lowest level since 2022. I mean, inflation is simply outpacing paychecks.
And we are seeing the immediate fallout of that. I mean, when everyday people are draining their bank accounts just to cover basic living expenses, it creates immense tension.
Tension for who? The Fed.
Yes, for the Federal Reserve. If we connect this to the bigger picture, they are watching that 3.3% core PCE number and trying to figure out how to cool it down.
Without completely breaking consumer spending.
Right, without triggering a full-blown recession. It is a very precarious balancing act. But this is where the first pillar we mentioned acts as a relief valve.
The geopolitical news.
Exactly. The ceasefire acts as a macroeconomic relief valve.
Okay, walk us through the exact mechanism there. How does a diplomatic agreement halfway across the world act as a relief valve for a central bank sitting in Washington, D.C.?
So it basically comes down to energy and supply chains.
Okay.
Geopolitical stability in the Middle East directly impacts global oil futures. So when the threat of an immediate conflict recedes, the fear of a sudden energy supply shock diminishes too.
Which stabilizes the cost of a barrel of oil.
Exactly. Now, even though the Fed looks at core inflation, which excludes direct energy prices, the cost of oil inevitably bleeds into those core numbers anyway.
Right, because it dictates the cost of shipping goods.
Shipping goods, manufacturing, running agricultural equipment, you name it. When oil prices stabilize, shipping costs stabilize.
And that eventually caps the prices of consumer goods on the shelf.
Bingo. So the market is rallying today, partially on the hope that this ceasefire will naturally help bring that 3.3% inflation down.
And spare the Fed from having to aggressively hike interest rates again.
Exactly. It does their job for them, basically.
Well, I follow the logic on the shipping and manufacturing costs, but I have to push back a bit on behalf of the listener here.
Sure, go for it.
Let's look at the juxtaposition. Everyday Americans are draining their hard-earned savings down to 2022 levels just to keep the lights on and buy groceries.
Yeah, the data's rough there.
Right. Meanwhile, the broader stock market is popping champagne at record highs. How can these two things be true at the exact same time? Is Wall Street simply ignoring Main Street?
Man, that is the defining question of the current economic cycle.
It feels completely disconnected.
It does, but the answer isn't that Wall Street is ignoring Main Street. The answer is that we no longer have a single unified economy.
What do you mean?
We essentially have two wildly divergent economies operating simultaneously. And because the stock market heavily weights corporate profits over household stability, it rewards the side that's booming.
Wow. Yeah.
To see this in action, all you have to do is look at today's earnings reports.
Okay, let's unpack this, because it's like two different realities living in the same house.
Right.
The retail side is basically digging through the couch cushions for spare change, while the enterprise tech side is, well, popping champagne.
That's a perfect way to frame it.
Let's look at that first economy, the consumer reality.
Yeah.
The top losers in the market today perfectly illustrate that retail slowdown. Gap shares plummeted 13% today.
13% in one day is brutal for a retailer.
And they actively cut their forward sales guidance too, citing deeply disappointing performance specifically from their Old Navy brand.
Yeah.
Then you have American Eagle. They managed to beat overall Wall Street expectations, but sales at their core namesake brand still fell short of estimates.
Right, because Old Navy and American Eagle, they're classic barometers for the middle-class consumer.
They aren't luxury brands.
No, and they aren't deep discount dollar stores either. They sit right in the middle. So when everyday Americans realize their wages aren't keeping up with a 3.3% inflation rate, what happens?
They cut discretionary spending.
Exactly. The very first line item they cut from the household budget is clothes. They delay buying that new pair of jeans or that back-to-school jacket.
So the traditional retail sector is feeling the immediate, tangible pain of that depleted savings rate.
Very tangible pain, yes.
It's just wild. It's like looking at two completely isolated balance sheets. The household budget is slashing expenses just to survive. But then you pivot to the enterprise and technology sector, and it's a completely different universe. Let's look at the top gainers. Dell saw its shares skyrocket an astonishing 23% today.
23%, just incredible.
They reported their fastest sales growth since returning to the public markets in 2018. We are talking about a legacy hardware company jumping 23% in a single trading session.
And the mechanism behind that jump is crucial to understand. Dell's revenue isn't surging because consumers are buying more laptops for their home offices.
Right, this isn't consumer spending.
Not at all. It is surging because massive corporations are authorizing billions in capital expenditures to buy enterprise-grade infrastructure.
Because of AI.
Exactly. Building and running artificial intelligence models requires highly specialized, incredibly dense, liquid-cooled server racks.
And Dell makes those.
Yes. Dell has positioned itself as one of the few legacy companies capable of assembling and shipping these complex physical racks at a true enterprise scale.
So corporate balance sheets are essentially funding an infrastructure boom.
A huge boom.
And it's not just the physical hardware either. Okta, the identity and access management company, rose 8% today.
Right, on the software side.
Yeah, they topped their Q1 results. And the catalyst was a surging demand for what they termed agentic AI tools.
Agentic AI, yes.
Let's translate that for the listener. What makes an AI agentic, and why is Okta profiting from it?
Sure. So a standard AI model operates a bit like a highly advanced search engine. You give it a prompt, and it gives you an answer. It's purely reactive.
Right. Write me an email or summarize this article.
Exactly. Agentic AI, however, is proactive and autonomous. You give it a broad objective. For example, optimize our quarterly supply chain logistics.
Okay.
And the AI acts as an independent agent. It breaks the goal into steps, interacts with various software databases, alters code, and executes tasks across a company's network without human intervention.
Which, I mean, that sounds incredibly efficient for a corporation, but it also sounds like a catastrophic cybersecurity vulnerability.
Oh, absolutely.
If you have an autonomous program moving through your corporate network altering data, you need to know exactly what it has access to.
Precisely, which is exactly why Okta is up 8%. Securing autonomous AI agents requires an entirely new, rigorous layer of identity and access management.
So they have to verify the AI just like they verify a human employee.
Exactly. Companies are terrified of falling behind in the AI race, so they are buying the hardware from Dell to run the models, and they are buying the security protocols from Okta to ensure those models don't compromise their internal networks.
Wow. The contrast is staggering. The retail sector is struggling to sell basic apparel, while the enterprise sector is fundamentally rebuilding the architecture of the modern internet.
That's the split reality we're in.
And because companies like Dell and Okta hold significantly more weight in the S&P 500 than a clothing retailer like Gap, the index is pulled upward.
Right, because the major indexes are market cap weighted. The biggest, most profitable companies dictate the direction of the broader market.
And right now, those biggest companies are all in on AI.
Entirely focused on this AI transition.
So let's follow that thread, because the numbers coming out of the AI sector today are almost difficult to process.
They really are.
Snowflake, the cloud data platform, surged 36% today. That single move is acting like a gravitational pull, fueling a broader rally across the entire software sector.
And we also have to look beyond the public exchanges to the private markets because the scale of capital being deployed is just breathtaking.
Oh, you're talking about Anthropic.
Yes. Anthropic, a leading AI research firm, is nearing a $1 trillion valuation in its latest funding round.
$1 trillion for a startup.
Let that sink in. It makes Anthropic the most valuable AI startup on the planet.
It's unbelievable.
And then over in the semiconductor space, ARM Holdings hit another all-time high today. This is driven by the insatiable demand for the specific product architecture required to design AI chips.
And that brings us to the most active stocks trading hands today: Nvidia, Apple, and Alphabet.
The heavyweights.
We are seeing a fascinating narrative shift play out in real time here. Analysts are now openly comparing Nvidia to Apple, with several arguing that Nvidia actually possesses far more growth opportunities ahead.
It's a huge debate right now.
Now, here's where it gets really interesting. I have to play devil's advocate here. Apple essentially invented the modern consumer tech ecosystem.
True.
They have over 1 billion active devices globally. They have a massive cash pile. Their walled garden is practically impenetrable. Does Nvidia really have the runway to outgrow the most dominant consumer monopoly in modern history?
What's fascinating here is that it represents a profound shift in market psychology.
How so?
Well, for the last 15 years, the most valuable real estate in the global economy was the consumer's pocket.
The iPhone.
Exactly. Apple owned that real estate. They controlled the hardware, and they taxed the app ecosystem that lived on it.
The 30% App Store cut.
Right. But what analysts are pointing out today is that the market is pivoting away from valuing the interface and moving toward valuing the foundational infrastructure.
So if Apple is the landlord of the mobile internet, collecting rent on every app and subscription, what is Nvidia?
Nvidia is positioning itself to be the utility company for the AI revolution. And everyone has to pay the utility company.
Oh, that's a great way to put it.
The market is betting that the next decade of wealth generation won't be defined by who sells the sleekest smartphone, but by who provides the underlying computing power.
Because everyone needs that power.
Everyone. Nvidia is manufacturing the chips. ARM is designing the fundamental blueprints for those chips. Anthropic is building the foundational models that the software will run on.
So even a giant like Apple has to rely on this infrastructure to power its next generation of features.
Exactly. They can't do it alone.
But, here is the physical constraint to that utility company metaphor.
Okay.
When we talk about AI, we use these really ethereal words. We talk about the cloud or software models or virtual agents.
It makes it sound weightless.
Exactly. But you cannot build a trillion-dollar data center out of thin air. It requires physical, heavy, highly specialized materials. And that bridges us to a really telling sector trend from today's sources.
Ah, yes. The transition from the digital software frenzy back to the physical commodities required to build it.
Right. Because behind the scenes of Snowflake's massive 36% jump, the rare earth sector saw significant movement today, too. Companies like Realloys and MT Materials were making serious headlines. We're talking about the physical mining of elements that are absolutely critical for manufacturing the hardware.
And this is a vital connection for you, the investor, to make. An ethereal AI agent requires a physical microchip.
Right.
And that microchip requires specific rare earth minerals, elements like neodymium for high-performance magnets or yttrium for complex capacitors.
Stuff you literally have to dig out of the ground.
Exactly. You do not get the software without the hardware, and you do not get the hardware without these highly specific rare elements being pulled out of the dirt.
So the entire supply chain for Nvidia, ARM, and Dell relies on the steady availability of these materials.
Yes.
So while retail investors are maybe distracted by the shiny consumer-facing AI tools, the true choke point of this modern gold rush sits with the rare earth miners.
They really are the ultimate picks and shovels of the AI revolution.
That's fascinating.
They are the physical anchors of the digital economy. While the software companies make the flashy headlines with trillion-dollar valuations, companies like Realloys and MT Materials hold significant structural leverage.
Because if they stop digging, everything stops.
Right. If the supply of these minerals tightens, the entire enterprise tech rally hits a physical wall.
It really forces you to view the market in 3 dimensions. So let's step back and synthesize everything we've covered today.
Let's do it.
The major indexes, the S&P 500 and the Nasdaq, hit record closing highs today. This momentum is driven by a macro relief valve, the U.S.-Iran ceasefire stabilizing energy fears,
Right.
and a highly concentrated explosive capital deployment into AI infrastructure.
Yes.
And all of this is happening while core inflation stays sticky at 3.3%. The everyday consumer drains their savings down to 2022 levels, and middle-class retail brands like Gap take double-digit losses.
So what does this all mean for you? Understanding this stark divergence is really the key to navigating the current financial landscape.
You can't just look at the S&P 500 and assume everything is fine.
Exactly. You cannot look at a record high on the index and assume broad economic health. We are currently operating in a split reality.
The two houses.
Right. We have a stretched, exhausted consumer economy absorbing the blow of inflation on one side, and an explosive, cash-flush enterprise economy fundamentally rebuilding the tech sector on the other.
And the broader market is just strapping itself to the enterprise rocket ship, effectively hoping that the weight of the exhausted consumer doesn't pull the whole thing back down to earth.
Which leaves us with a rather profound paradox to chew on.
What's that?
We've detailed how AI is making enterprise tech companies vastly more efficient and valuable. The capital expenditures are massive.
Right.
But simultaneously, the everyday consumer's purchasing power is eroding.
Fast.
Yes. So if the enterprise sector continues to build these incredible, high-margin, AI-powered products, but the everyday consumer is going broke just trying to afford groceries,
Yeah.
who will ultimately be left with enough disposable income to purchase the products and services this AI is helping to create?
Wow. $1 trillion infrastructure is only valuable if there's a solvent end user on the other side of it.
Exactly.
That is a heavy question to leave hanging over these record highs. That's all for today's deep dive of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.